So before we get into this lesson, let's have a quick recap on market structure basics. Here you have your high and here you have your low. When price comes back into the range, it forms your new higher high. When price breaks your new higher high, that would confirm your new higher low, and so on, so on. So when price comes back into the range, that will confirm your new higher high. And when it breaks the new higher high again, this will confirm your new higher low. So this is your basic market structure via candlestick print. Here you have your range. Price closed below the range and came back inside of the range. Okay, here you have your supply and demand structure. So what it basically is price breaks your structure, forms the peak, comes back inside of the range. Once it comes back inside of the range, it uses a supply or a demand level, which could be at an extreme or it could be somewhere in the middle of the range to push price back out. And same thing inverted. So what it basically is you have a swing, price breaks the swing, and instead of continuing above, let's say reacting from this level and then expanding, price will come back inside of the initial range and then expand from there, come back inside of the initial range and expand. This would be your supply and demand structure. So here's an example of a supply and demand market. So you had your swing high right here. This was your range previously. What did price do? Price broke structure here and came back inside of the range. So now what? So now this was our high. And this was our low. So now what did price do? Price came outside of the range, then came back inside of our range and expanded. So once price expanded, what is our range now? Once price broke this structure, what is our range now? It would be this and this. So now what happened? Price broke structure here, then came back inside of the range. So this is a supply and demand structure. Why? Because price is moving through internal liquidity. Price is breaking structure, coming back inside for internal liquidity. What is internal liquidity? It's inefficiencies inside of the range. External liquidity would be outside of the range. Internal would be inside. So price is breaking structures and coming back inside of the range to grab orders to get the buying power to continue above. Here we have support and resistance structure. What is the difference between support and resistance structure and supply and demand structure? Is support and resistance, price does not come back inside of the range. Price rejects from the previous peak. As you can see, price rejected from the previous peak and expanded. It never came back inside of our range. So price breaks structure and never comes back inside of the range and continues above. So basically, instead of your supply and demand market structure, where price breaks structure and comes back inside of the range, in the support and resistance structure, price can break structure but never come back inside of the range. It can react from the peak or a little bit before to expand. So here's an example of support and resistance market structure. So here you have your range. Price rejected. without entering your range. So this would be your support and resistance structure. You can see here your new range has been formed. What does price do? Price does not come back inside of the range, finding rejection right here. So this would be your new range, your new low and your new high. Your high will be determined once price breaks the structure. So what happens here? Price rejects without entering the range. Price finds rejection right here, forming your new range. Here's your low, and here's your high. Price forms a low and does not come back inside of the range. And here you have your rally base rally or drop base drop structure. So it's basically a momentum gap. So price would just explode one level, pull back and explode, pull back, explode, pull back, explode, leaving huge gaps, which is different from a support and resistance structure. Support and resistance structure would retrace a little bit deeper, maybe all the way to its previous peak or at least nearby. But when price doesn't even attempt to retrace back to the previous range, this would be your rally base rally or drop base drop. So here's an example of a rally base rally. So here you have a rally, then a base, then a rally, base, rally. And the trick here is a lot of times a rally base rally or a drop base drop structure, a lot of times it's a support and resistance structure. But the key here is it's a macro version of a support and resistance structure. So what you would have to do is you have to lower your time frame and you'll be able to see your support and resistance structure. Should be here. Until price changes profile and goes back into supply and demand. Let's take a deeper dive and look into your range inside of a range. So that'll be working between macro and micro. So macro will be your higher time frame. So let's say you have your swing high, swing low, and expansion. On the lower time frame, which would be your micro, price is actually doing this. Basically, it's the same price delivery, but when you zoom in and go on a lower time frame, you start seeing consecutive structure. You start seeing lower lows being made inside of your range and higher highs. And that all depends on the macro structure. So if you know that price is coming back inside of the range, you would anticipate a bearish order flow. And when it's reacting from a discounted level, which would be your discount range extreme, you would expect a bullish order flow. And we're going to cover this next. What do you see here? You see price in a bearish structure. Price is rejecting from internal liquidity and continuing down, breaking structure, and you would anticipate price to continue bearish. So what is your macro range here? This is your swing high and this is your swing low. But look how price looks on the micro, on the lower time frame. Now you start seeing a structure within a structure. So now you start seeing price breaking down to the low, forming lower lows, then price switching character, forming higher highs, rejecting from your extreme here forming a consolidation, and we know price accumulates before reversing, breaking structure, and continuing lower. So this is a range, a micro range within a macro range. So this is basically structure inside of a structure. So let's go over the correlation and how you can use the both time frames to anticipate order flow and directional bias. So this is your macro, and price just broke structure and came back into the range. So what do you know when price breaks structure and comes back into the range? If we are in a supply and demand structure, we know the price is targeting supply and demand levels, which in this case would be your extremes. So you would pull out your fib, and first thing you would want to do is you would locate your danger zone. Your danger zone would be the extreme. So in this case, you have bearish order flow all the way until this danger zone. And then here price might be bought to continue with the initial trend, which is bullish. But here you're going counter trend. You're going counter macro trend, but on the micro, which is the lower time frame, you are in line with the order flow. And if you are a lower time frame trader, you wouldn't mind trading against the macro order flow because it all depends about ranges. So here, price would be bearish. You'd want to see evidence of a consolidation and then sequences of lower low. That's when you would confirm it. And then once price approaches here, you would want to see a stop hunt, consolidation, and price making higher highs. Once price start making higher highs, you are in line with the macro. So that's when the macro and the micro are in line together. So here you have your macro range. Price broke structure and came back and closed inside of the range. So this is when you go in your lower time frame and you pull out your fib and locate your danger zone. So your danger zone here this would be your danger zone. So once I start seeing a little bit of strength going bullish by a structure basis, you can say you have a bullish bias all the way up to here because price can always reject from range extremes. Price broke structure, showing strength. Formed your first range, back inside of the range. So here you have your major swing, high and low being broken. Price came back inside the range, now targeting this level and continuing higher. Now price reacted from the extreme and making lower lows. So as you can see what happened here, on the macro time frame, price broke structure here, came out of the range and came back inside of the range and reacted from your range extreme. So the character changed and your order flow was bearish. But on the micro time frame, you were bullish. Why were you bullish? Because once price breaks structure and comes back inside of the range, you have a bullish order flow until your range extreme. That's why price moves like this. It breaks structure And when it's in the supply and demand, it comes back inside of the range. Uses internal liquidity, comes out of the range, takes external liquidity, then comes back inside of the range. So bearish, bullish. Here, bearish. Once breaks out of the range, it's bullish.